could not have happened on the basis of an honest flow of finance. It was an intrinsically fraudulent process that we have to fix. The housing sector in the United States was a mature sector by the end of the 1990s, early 2000s. People who were prime credits, who were good risk for mortgages, by and large already had them. New households could get them, but this was not a market that could grow rapidly. And therefore, it could not be an important force behind sustaining the economic growth of the economy as a whole. In order to do that, you had to put finance in the hands of people who had never had it before. And that was primarily people who were not going to pay back their loans. And this was known to the lenders, who loaned to borrowers who would never occupy their homes. Many subdivisions' houses were never occupied. And to householders who were long-standing homeowners, but who would not have normally qualified for credits because they couldn't support the payments, and were given loans on terms that the lenders knew very well would never be met or repaid. And the market for bad loans is theoretically unlimited. It can go on indefinitely, so long as you can find someone else who will take the loss that inevitably will occur when the loan defaults cannot be renegotiated successfully. And that process carried the United States economy forward until 2007, when it came to an abrupt end, as the fact that this was the case became common knowledge and a matter on which financial institutions had to act. So they cut off lending to each other. And by that time, the entire world financial system was infected with this stock of fraudulent financial assets. Assets which had been originated in US housing had been given AAA ratings by the rating agencies on the basis of a highly problematic process, and then marketed to the world investment community by the commercial and investment banks. And when this collapsed, what fundamentally happened was that the Eurozone crisis was precipitated. The rise in the yields on the weaker sovereigns in Europe coincides with the selling off of the collapse in value of the toxic assets emerging from the United States. And this is perfectly understandable once one realizes it's a common financial market. And when you are faced with losses in part of your portfolio, what you're going to do is to sell off the weaker assets that are in other parts of it in order to protect yourself. And so you have this enormous differential with funds flowing out of the weaker sovereigns and into the stronger ones, into Germany, into Britain, France, and of course into US Treasury bonds. And of course, the household sector in the United States, deprived of credit and deeply shocked as far as prospects for employment and income are concerned, launched into a massive retrenchment, which is what brought production and employment down in the United States so intensely and rapidly. In the aftermath of the crisis, what we have seen in the United States is a process of stabilization, a process of, in some respects, fairly effective institutional intervention to prevent the absolute worst from happening. Well, we did not, in fact, move to a repetition of the complete collapse of the financial system and of economic activity that had happened in the early 1930s. Some of this was due to central bank action. In fact, a very large part of it was due to the massive assumption by the Federal Reserve of bad assets, massive provision of liquidity to the world financial system. Some of it was due to action by Congress, directly with respect to the banking system, and fiscal actions to support economic activity through the American Recovery and Reinvestment Act. A great deal was due to the stabilizing forces that were built into the system, the automatic stabilizers that gave us lower taxes and higher government spending. Economists, however, projected that there would be a much more rapid and effective recovery than has been the case. And they were, I think, assuming that this series of events was similar to what had happened in post-war business cycle expansions, when in fact, what we know is that it was fundamentally much more like what had happened in the early 1930s, and occurring under circumstances which were fundamentally unlike those of the post-war period from 1945 to 2000. And so, economic growth has not resumed, and economic activity is not on track to return to its pre-crisis levels. We have a whole series of impediments to that development. I mentioned the deleveraging going on in the household sector. It's to say people are going to pay down their debts, and if you give them more income, they'll pay them down even further. Not a bad thing, but not a source of expansion. There is what I will call the choke chain effect of energy prices, which is to say, anytime there is a little bit of investment, a little bit of recovery of activity, we see a rise in particularly in the oil price, which for us is an import price. And the terms of trade have turned against us on this over the last decade. It's not improving. And this is a constraint on domestic profitability and profit expectations. We have the fact that the technology revolution is going on still, and businesses have the capacity to save labor, and they are doing so. Can't blame them for taking advantage of digital technologies, but the fact is this deprives the labor force of private employment opportunities. We have the continuing deflation of prices in housing, real estate prices, which mean that more and more households are effectively insolvent as time goes on. And there's no prospect for recovery of construction, or of consumption based upon housing finance. And given that, we have a large banking sector, a vast banking sector in relation to total activity, which is not performing any identifiable public purpose. It's not acting in support of economic recovery, and it shouldn't be expected to. Because after all, when asset prices are declining, it pays to hold back to stay liquid and to buy them later when they've fallen even further. And that is the profit imperative that banks appear to be largely following. And then finally, we have a mentality of austerity, a reaction to all of this, some of it justified at the state and local government level, some of it simply ideological, which is working to prevent new initiatives in the public sector and to impose further scaling back of the social insurance institutions that are protecting us from a complete collapse. And that is where the political test in the United States is now about to occur. In Europe, actually the situation is even more serious because a coherent governing framework for the continental economy doesn't exist. The internal imbalance inside Europe between Germany and the rest is accompanied by a peculiar distribution of political forces which prevent the leading European countries from having, it actually means that if you're political leadership in those countries, you have no internal incentive to act on behalf of the stabilization of the continental economy. What happens in the peripheral countries is not a direct political interest to you, and actually being accommodating or progressive along those lines is politically exceptionally dangerous. So one has combined economics and politics of a spiral of destruction. And I think that is others will speak to the European situation with greater familiarity than I can, presumably greater length, but I think that is the essence of the European situation. Leaving, of course, countries in other parts of the world, and notably in South America, to some degree in the lead of these events, because these countries were not directly brought into the network of sales of subprime toxic assets, and they are not directly under the discipline of the European Central Bank. They benefit to some degree from low interest rates in the world, and also certainly in the last decade from higher commodity prices, and from the relatively strong markets provided elsewhere, particularly from China. And I think above all, from the revival of a social democratic, broadly social democratic tradition, which, as the governor has said already, provides a stabilizing force in the growth and stabilization of internal markets. But the protection cannot possibly be complete, because it's obvious that the outlook for the very largest economies has an important influence on the markets available to economies elsewhere in the world. So what is that outlook?